Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's Recon report, I'm walking you through one of my worst revenge trading mistakes. A trade on Meta that turned a structured setup into a costly mess. This was expensive tuition. The lesson was brutal. When emotions take over, the market punishes fast. Today I'm breaking down how the trade started, where it broke, and how a bad decision chain turned one loss into a much bigger one. Let's get to work. The plan. Meta was trading inside a pretty clear range at the time. On the chart, I had marked the levels I believed price would stay between, and from a technical point of view, it looked like a decent candidate for a quick range trade. Because the odds looked reasonably balanced between a move up and a move down, I decided to attack from both sides. I opened a bull put spread and, a bit later, added a bear call spread. Put together, that gave me the basic structure of an iron condor, although I was managing it as separate spreads rather than one single package order. The idea behind that type of setup is simple. If the stock stays flat, time decay works in your favor. But if the stock starts moving hard in either direction, you need to react quickly. That is the battlefield with short premium trades. They work great when the stock stays contained, and they can turn ugly fast when it doesn't. So far, the plan made sense. The problem started when I stopped following it. The engagement. I opened the first spread on April 30th by selling a bull put spread. A couple of days later, I added the bear call spread. At first, the bear call spread behaved better and turned profitable faster, so I closed it relatively quickly. The bull put stayed open because it still looked healthy. But then it started taking losses, and instead of cutting it, I decided to roll it. That was the first bad turn. At the same time, I opened another bear call spread, this time with a bigger position. By the end of May and into the beginning of June, I had active positions on both sides. Then June hit and Meta started moving hard. On June 3rd and 4th, the stock ran up roughly 7% and my bear call spread started losing money fast. With expiration approaching, on June 18th, gamma risk was starting to matter more. I closed the bear call, which was the correct move. But I still didn't want to take the loss on the bull put, so I did the dumb thing. I doubled down on the bull put and opened an additional spread. Because of how the strikes lined up, my long strike and an existing short strike got netted inside the platform, and suddenly the screen looked wrong. I thought the platform was glitching. I had no clear read on what my actual position was, and that made the situation worse. I even wrote to support asking whether something had gone wrong and what trades were actually opened. But while I waited for an answer, the market kept moving. And then, Friday, June 5th, came in like a hammer. Meta sold off hard. It dropped from around 615 to 580 in minutes. My short strike was at 585 and I was bleeding money fast. I wasn't even at my desk when it happened, and I can still remember the feeling of opening the platform and realizing I was staring at a mess. I was stuck with a loss, unclear on the exact position, and angry enough to make it worse. So I made the second dumb decision. I opened a bear call spread to offset the loss using the same DTE and basically trying to patch the hole with more trades. That is revenge trading at its best, or worst, depending on how you want to look at it. I kept the position open over the weekend. By the following week, the bleeding still wasn't done. Support replied after several days, basically confirming that the positions had been netted and I had to figure it out from there. At that point, there was no clean escape. I had to close at a much worse price than I wanted. And even then, I still left part of the second position open because I didn't want to eat the full loss immediately. Of course, that just made it worse. The sell-off continued and the loss kept growing until I finally closed everything out on June 11th. The outcome. On screen, you will see the full breakdown of all of my Meta trades. The total loss, excluding commissions and fees, came down to $2,927. On a $50,000 account, that works out about 6% of account value, which is roughly 3 times my normal maximum acceptable loss of 2%. This is the part that matters. The real lesson here is not that Meta dropped hard. Stocks do that. The real lesson is that I let emotions take over. I didn't want to take the first loss. Then I tried to fix it with even more risk. Then I refused to cleanly exit when I should have. That is how a manageable trade turns into a serious problem. And that is exactly why you need rules. Not vague rules, real rules, hard rules. Rules you follow even when you're angry, confused, or convinced the trade should come back. Because once emotions get the wheel, the trade is usually already lost. So here's the recap. The setup started as a range trade on Meta. The structure made sense. The problem was execution. I let the position get away from me, I tried to patch it with more trades, and I turned a bad situation into a much worse one. The lesson is simple. Don't let emotions run the trade, don't revenge trade, don't refuse to take the loss, and don't keep adding risk just because you hate the number on the screen. Trading rules exist for exactly this reason. They don't protect you when things are easy. They protect you when everything is going wrong. And with that, we wrap up this episode of Recon Reports. If you found value in this mission, be sure to lock in your support by liking, subscribing, and following the movement. If you like this episode, also drop a comment in the section below. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, stay on target.